All right, warm welcome everybody to a brand new week. Now, in terms of the economic calendar, we've got a very busy one coming up this week. We start off the week on Tuesday with the Bank of Japan policy decision, as well as US retail sales out later on Tuesday. On Wednesday, we've got UK CPI data coming up, followed by, or ending the day rather, with the FOMC policy decision. That is followed up on Thursday with Kiwi GDP data, Aussie jobs data, the SNB policy decision, as well as the Bank of England policy decision. So it's going to be a very busy one on the calendar. However, I will be covering these ones individually. For now, the main focus for this video, the shorter than usual week ahead video, will be on the major geopolitical theme we have going on right now and making sure everyone is aware of what's going on and what we could potentially expect in early trading going into Monday. Now, for those of you who are not aware, on Friday we had a pretty crazy day in markets, all down to this geopolitical situation. What exactly happened? Well, for those of you who don't know, Israel launched a what they called a preemptive strike against Iran. It was a total of close to 200 Iranian military, nuclear, as well as infrastructure sites that was targeted. Massive coordinated air and drone assault coming out from Israel. They basically did this in retaliation against the growing, what they call fears, obviously from Iran from a nuclear point of view. They also hit a couple of the uranium facilities in Isfahan. And I think they also hit a couple of defense infrastructure sites as well. So this was a massive escalation, and even though there was hints of this potentially going to happen, even early last week, the markets didn't really pay much attention because firstly, they weren't 100% sure whether it's gonna happen. But obviously when the US started pulling some of their personnel out, that got a little bit more serious. And then on Friday, it was just a massive brown stuff hitting the fan moment for the markets. Big reactions, as you would expect initially across major asset classes, but we haven't seen a lot of follow through, but we'll touch on that in a second. Let's first see how markets reacted initially. Basically, as you would expect, the biggest mover on Friday was oil. Massive rush to the upside. I mean, at some stage on the day, oil was up close to 13%, just a monster of a move. We closed up at the going into the end of the week up about 7%, but it was a monster move for oil. Something that's been pressured to the downside for months now. You can just see the veracity of that move compared to the recent volatility we've had over the last 2 years. That was a real big mover on Friday. Also, similarly, if you take a look at equity markets, we saw some downside pressure playing into those major indexes like the S&P 500. Over 1% down at some stage. It did recover some of that initial loss, and then the Nasdaq as well pushing lower, also recovering some of that initial loss. And we obviously saw things like the VIX popping to the upside. The biggest mover on the volatility side was of course on oil, where if you look at OVX, which is WTI's equivalent of the VIX, you can just see the massive rush we had to the upside in the OVX, reaching levels last seen going back to 2022. So just a monster reaction there from an oil point of view. Not as much as I would have expected for equities. We also saw a little bit of upside coming into the US dollar, which was a surprise because remember, we've had bouts of risk off sentiment over the course of the last, what's it been now? Let's just say 8-9 weeks. But the dollar has failed to gain a lot of upside in those events because there's a lot of things pressuring the dollar right now. For many, it has lost a little bit of that safe haven shine, but even the dollar, which haven't really been trading as a safe haven, even the dollar was able to get off the lows on Friday, given the rise we had in geopolitical risk, and obviously things like gold, which is seen as a hedge in environments where we have geopolitical risk escalating. That saw a nice pop to the upside as well, getting very close to that 3,460 level. So that was the initial reactions and the closes on Friday. Now, even though these were definitely punchy moves, especially if you look at things like oil, in my opinion, I was quite surprised by the market's lack of follow through. Normally when these things happen, you tend to see a little bit more risk premiums being priced into the markets, especially when it comes to equities. But equities was very well behaved on Friday. It was really just oil where we had a big reaction, and we'll touch on why that is in a second. Now, in the market's defense, these types of developments usually only have short-term impact in the markets. If you think back to, Russia's invasion of Ukraine, it mattered for the markets a whole of about 3 months. And then the markets got over it very, very quickly. And that's something that it's not even in the market's purview right now in terms of risks, right? So that is always important to understand. These types of things tend to only impact the markets in the very short term, and then they get used to it. However, the uncertainty was still so high going into Friday, and there were so many things that could have happened over the weekend. I was genuinely surprised on Friday that the markets didn't price in higher risk premiums across the board, not just for energy, but also for FX as well as equities. I'm still short the Nasdaq on the back of that, expecting a bit of a move lower, and the markets was just not having it. That was quite a surprise, and I do think, and again, this is just my personal view, I think the markets took that way too lightly on Friday, and I am expecting a bit of a risk of reaction going into the open on Monday. The reason for that is all of the developments that we had over the weekend. So over the weekend, the following things happened. Obviously, Iran retaliated. Everybody expected them to retaliate. They retaliated with multiple missile strikes, drone strikes. They targeted Israeli infrastructure, especially in those main cities, and some projectiles, even though they were intercepted, others did cause civilian casualties as well as power disruptions. And in response to that, Israel carried out a second wave of strikes, this time reportedly hitting key Iranian energy, that's important, as well as military sites. Now, the one that got the markets a little bit spooked was a hit of Iran's natural gas processing plant at the South Pass field. Now, that is one of the critical hubs when it comes to Iran's energy infrastructure. And remember, they were already facing major power outages. I think it cost them something in the vicinity of 200 or 220 million per day. They've obviously got a massive worsening economic situation right now. They've got super high inflation. So that hit on energy infrastructure was a definite escalation from Israel's side. That is why I do think markets open up with a little bit of a risk-off tone. And there's also fires that broke out at multiple oil depots, which is important. Again, we'll touch on that in a second, as well as other gas plants around Iran as well. Now, why is all these things important? It's important because there's been a very clear escalation over the weekend, and in my opinion, what we've had, it felt like at some stage on Friday that the markets thought, what's the worst that can happen type of thing if you look at how equities were trading. And I do think that things have escalated a little bit more seriously now, especially with Israel not backing off on energy infrastructure, right? Because that's a real critical point for macro right now, because remember, we just got off of one of the worst inflation scares in 4 decades, right? There was huge supply disruptions that happened with COVID, and then obviously everything else that came alongside that. The markets are just out of that fear of inflation, and now a possible new supply disruption is on the horizon. Now, I'm not saying this is going to be the same type of impact as something like COVID or whatever. I'm not saying that. What I'm saying is that the markets, in my opinion, took the possible risks of how this could potentially play out far too light going into Friday's close, and I'm expecting a bit of a risk of open. What would we expect on a classic risk of open? You would expect downside in things like equities. You would expect upside in things like oil, obviously in line with the risks to supply. Upside in things like gold, upside in things like the US dollar. That is my baseline view for how markets will open up. However, how we continue to trade after the open will obviously be based on whether we get further escalations or possible de-escalations. We've already heard some comments coming out from Iran saying that if Israel stops attacking, they will stop attacking as well. So there is already some pushback in terms of trying to get to some type of resolution. But if things just continue to go bonkers, things to look out for on the good side is obviously possible ceasefires, maybe brokered with the help of other countries like the US or whoever. That is one to potentially watch. If we do hear noises of a ceasefire, you would expect those risk-off moves to reverse, right? If there is noises of a ceasefire, you would expect equities to recover higher. You would expect things like gold to push lower, oil to push lower, and the dollar to push lower as well. So watch out for possible ceasefire de-escalations taking place. In terms of escalations, what could happen? Well, obviously the current developments over the weekend, like I said, is likely to see some risk aversion at the open. At least that would be my personal baseline assumption. But for real, serious escalations, what the markets will be looking for is firstly the severity of impact on the civilian populations, right? The greater and greater that becomes, the greater the risk is that they pull each other into a far bigger conflict, which has a regional escalation risk factor to it as well, right? So that is obviously a bad case scenario. The worse and worse the strikes get, the more and more civilians get unfortunately, killed in the process. That could see greater escalation of something more serious. The other one is if Israel starts hitting very important oil infrastructure, because up until now they focused most of their strikes on gas infrastructure. If that starts to turn into oil, then from a macro point of view, the markets will be very, very concerned very quick, right? Because that starts to increase the risk of maybe some possible escalations from Iran, possibly even looking for restrictions to the Strait of Hormuz. Now, the Strait of Hormuz is something that you will be hearing a lot about, and you probably heard a lot about this over the weekend as well. For those of you who don't know what it is, what is the Strait of Hormuz? Let's quickly go on Google Maps and I'll show you where it is just to give you an idea. So if we go to the Persian Gulf here, this little strait over here, this little isle, if you will, is the Strait of Hormuz. It connects the Persian Gulf to the Gulf of Oman. Now, the reason why this is such a very important bottleneck when it comes to energy is there's roughly 20%, right? 20% of global oil and LNG flows through this strait. 20% of the global oil and LNG flows, right? So this strait really matters. Now, what we had over the weekend is we did have Iran coming out saying that they are seriously considering blocking the Strait of Hormuz. Now, I'm not a military or a geopolitical expert by any means, so I'm not gonna go through all of the possible ways that they could do that and how other players could potentially counteract that and try and move around that. I'm not going to go into all of that. The risk is that they are threatening to potentially block the strait. Whether it's even possible or not, let's just assume for a second it is possible. Let's assume for a second that they do achieve something like that. That, by estimates of players like Goldman, could see a very quick and easy bump of about 25 to 30% upside in oil prices. That is massive, right? So the Strait of Hormuz is going to be a critical thing to watch, especially if things escalate more. If it gets so serious that Israel starts striking those key oil infrastructures and Iran goes for the strait, that's going to be massive. Now, there's also some thought about this, from the energy community saying that would Iran even do something like that? They've obviously threatened that they will, but, if they do something like that, it would severely hit their already struggling economy. So it would be a bit of an own goal for them to do something like that. But if, let's say, things get so bad that they feel that they've got no other way out than to do that, to try and broker some type of a deal, then obviously that would be really bad. And again, the markets, central banks, everybody would be looking at that as a possible new supply chain disruption. And that could send inflation expectations up, oil up, the dollar up, equities down, gold up. It could be a massive, massive escalation if something like that should happen. So this is going to be a key focus point. Expect to hear many talking heads talking about this over the course of the week. It's going to be a key focus point for the market. So just to keep that in mind. So Let's quickly go to the charts then and see what we would expect to see. Look, it's always difficult to know how the markets or how big gaps could potentially be over the mark, coming into the new week. My baseline expectation, like I said, is to see similar continuation of the moves we had on Friday, meaning upside oil, upside gold, downside equities, upside dollar. In terms of where we open, I don't know. I'm not even going to try to guess where key levels are that markets will be opening up for. I'm just going to try and look for levels where, if we do see it opening up at certain levels, where could possible pullback levels be to maybe re-engage the markets back to the upside or to the downside, depending on what you're trading and which direction you're trading it in. So let's just assume we do get a pop to the upside in oil and it's a massive escalation. Key levels to watch to the upside would be obviously Friday's highs, coming up around that $77.50 per barrel level, very close to 78. Above that, we've got so many key levels to watch out for. We've got the weekly implied volatility high at the $79 per barrel level. We've got 80 coming up on the high going back to the 15th of Jan of this year. Those are going to be critical levels of resistance to watch in the week ahead. If we get massive de-escalations, and it's good news, we'll be looking for tripwires all the way to the downside. Key one would be the high going back to the 2nd of April. So that $73 per barrel level would be a key tripwire to watch to the downside. If that falls, obviously a move all the way back to where this entire move started would be reasonable if we get a total de-escalation of the situation. So very key levels of resistance and support to watch for the week ahead. What about equities? Now, this is something that I am trading myself already. I'm expecting a bit of a gap to the downside on Monday. I don't know how big it's going to be. I was already surprised on Friday that we weren't lower. So maybe we don't even see as big of a gap. But personally, as long as things remain elevated and risky without the scope of a short-term ceasefire, levels I'm watching to the downside would be the weekly implied volatility low. Now take a look at what nice confluence we have for this. We've got that level coming up right on top of the yearly opening range, which on this chart is very close to that 21,000 psychological level. So you've got the 21 level, you've got the weekly implied low, you've got the yearly opening range. That's a very key level of support to watch, as well as support going back to the 30th of May, support going back to the 22nd of May, the 21st of May, 19th of May. You get the picture. That is going to be a critical level. If we get there, I'll most likely look to take some profit off the table, move stops to break even, etc. Below that, we've got the 200-day moving average, which is going to be a critical one to watch. Very similar if you're trading things like the S&P, very similar levels to watch there. We've got the yearly opening range at 58.82 on this chart at least. We've got the weekly implied volatility low coming up nicely around the 200-day moving average. So key levels to watch there for the S&P as well. For the gold traders out there, what levels do we need to watch? Obviously all-time highs at 3,500 or 3,500. That's going to be a critical one to watch, especially if we have more escalations. Again, we would expect a bit of a gap to the upside. Are we going to gap up above all-time highs, below all-time highs? I don't know. Again, I'm not going to pretend to try and figure out where we're going to open. Let's just see where we open. Let's just take it as it comes, and we'll see how to trade it from there. Obviously, all-time highs will be critical. Once that breaks, you're an open air country, right? Who knows how high it can go? It'll depend on what type of escalations we get. In terms of levels to aim for, round numbers are normally key, right? So breaking through 3,500, next level you would aim for would be 3,550, then 3,600, then 3,650, etc. Again, that would be all-time high. So who knows how far it can go. In terms of levels to watch in the case of de-escalation, obvious level of support would be back down towards that 3,366, critical level of prior resistance over the course of the last few weeks now. So that'll be a critical one to watch for gold, I think, to the downside. If that folds, it could be a possible tripwire to take us back down towards 3,300. So key one to watch there. In terms of the US dollar, look, I'm going to give this one a skip when it comes to the geopolitical situation, because it just didn't react the way that I would have expected to. Didn't see a lot of upsides from it, despite the big moves we had in the likes of oil. your baseline's expectation would be upside if it's risk off, downside if it's de-escalation, but I want to see how this one trades first, and then I'll make up my mind on how to potentially trade that. Remember, we've got things like the FOMC and those things coming up as well, so that is going to be important to watch. But for now, it's important to understand how we expect markets to react at the open on Monday. Be wary of that. Watch your 6 on those assets, especially if you're trading any of them, and then watch the news for any potential escalations or de-escalations. By the time, who knows, by the time that you watch this video, the situation might have changed already again. So very important time right now to be watching that news, because it is, it's very important across major asset classes and something definitely worth your while just keeping track of if you are trading any of these relevant markets. So with that said, like I said, I'll mention or go through the other events individually, but this one was important just to get this out, making sure everybody's prepped for the open on Monday.